now for some... And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is the Hump Day edition of The Real Investment Show as we get ready to wrap up this week. Of course, today is NVIDIA's earnings. It's kind of all eyes on that one company. That's how big of a company this has become to earnings season is now. The volatility measures, all this are all tied into NVIDIA's earnings this afternoon. Of course, you know, the risk is that they come out, and this is a topic that we have in today's daily market commentary, talking about the reason that we trimmed our position in NVIDIA yesterday. And the reason is that the earnings expectations are very high for NVIDIA. Now, they are likely going to come in and beat earnings. They're likely going to beat estimates. They're likely going to beat their revenue numbers. The problem becomes, and we saw this with Palo Alto Networks, we've seen this with other companies, even though earnings are great and they meet their guidance, that's a disappointment, right? They have to come out and up the game. And the estimates for NVIDIA are already extremely high. They're expecting next year for them to generate nearly $144 billion in revenue. That's a big jump in revenue from this year. So again, expectations are already very elevated. So if NVIDIA comes out and just says, yeah, we agree with the outlook, that's where we think we're going to be, that's going to be a disappointment in theory to Wall Street. We can see that stock sell off. And the problem is that the upside in NVIDIA versus the comparative downside of a disappointment is about, the downside disappointment is about a 2-to-1 risk, right? I mean, in other words, you could lose twice as much on the downside as you can make if the earnings are great. The stock might be up 10% tomorrow, but if they miss on guidance, you could see the stock down as much as 20% to the most recent support level. So again, there's a risk there, and this is the reason that we trimmed off our position in NVIDIA yesterday, is just simply we don't know what the earnings announcement is going to be. And again, it's not that there's any risk with the earnings. We think the earnings will be fine. It's all about the guidance. And we've seen this repeatedly throughout earnings season this year, is that a company that comes out and just disappoints on guidance. They are brutally beaten to the downside and not really rewarded that much on the upside. So again, just a little bit, bit of preparation, just reduce the position back to our target weighting. It's had a decent rally since we added to it back in April. So again, just kind of took that little addition off, rebalanced it to target, and we'll just see what the earnings are this afternoon. We know we've still got our position, so if earnings are great and the stock is up sharply tomorrow, fantastic. If it's down sharply tomorrow, we'll add back to the position. So it's just simply a measure of managing risk in the portfolio. Also, FOMC minutes are coming out today as well. So what did the FOMC say at their secret meeting last time? It's always the same kind of stuff. We get these minutes out and pretty much we already know what they're going to say because that's been the message from all of the Fed members really all week. We've had just a ton of speeches this week from Fed members talking about inflation's still a little bit too high, not coming down as quickly as expected. We're going to cut rates. There's no talk about hiking rates, but we may have to wait a little bit longer to cut rates. In fact, expectations are now that the first rate cut will be at the September meeting, not the June meeting. So again, getting pushed out to the second half of the year. And that's really been a pretty consistent message. I would expect the minutes to probably reflect that. What we're going to be looking for specifically in those minutes, though, are indications about employment and potentially about homeowners equivalent rent, which is the big driver for inflation. So we'll see if there's any mention of those two items in those minutes today, but that will also add to the volatility of the market. Now, interestingly enough, yesterday was an extremely low volume day for the S&P. So everybody's really just kind of anticipating the announcements today. So NVIDIA, FOMC, that's the big stuff for today that's going to move the markets. Yesterday, market volume extremely low. In fact, it was one of the lowest trading volume days that we've had in the last several years. Again, just really everybody's just sitting still waiting for NVIDIA's earnings today. Okay, here's what you need to know before the bell this morning. Market sitting right at all-time highs. Again, as we talked about yesterday, we're just really, if we kind of zoom in here a little bit, what you'll notice is that we're just trading over the last 5 days within a very tight range. So we closed yesterday at the intraday highs of what we've done over the last few days. So again, markets have rallied to where we closed yesterday, sold off a bit intraday, closed a little bit lower. We did set a closing new high yesterday, so that was good. But again, if you just kind of take a look here, we're just kind of flatlining the markets here right now. And again, that's what we had talked about previously, is that markets had a very nice gain here from those April lows, and we just kind of gotten fairly extended. So again, price gains are just going to be a little bit harder to come by, particularly when the markets are as overbought as they are right now. So again, there's a reasonable risk that despite whatever NVIDIA says today or the FOMC says today, there might be a little bit of upside here, but the real risk in the short term is going to be a correction back towards this 20-day moving average. So again, if you're looking at the markets at about 5,300, you're looking for a correction back to around 5180-ish on the S&P. So it's a decent correction, right? So you got about 120 points of downside in the markets. Again, it sounds like a lot, but a couple of percentage decline would not be outside the realm of possibility. In fact, we have not had a 2% down day in the market in over 315 days. So it's a very long stretch of time that we've not had a 2% correction day in the markets. So again, disappointment tomorrow, this evening from NVIDIA, FOMC minutes, something could certainly create a bit of a sell-off here. But even good news is likely going to be difficult to lift the markets a whole lot higher here very rapidly. Again, we can just kind of continue to climb higher as the 20-day moving average starts to catch up. But as we talked about yesterday, once we kind of get to that upward trend, it becomes an issue where the market continually kind of retests that 20-day moving average. It becomes kind of the trend support for the markets during and advance. So we've got to kind of close this gap between the 20-day and where the markets are currently trading. So again, market declines a bit, 20-day moving average moves up a bit, but we kind of close that gap. And then that becomes back into, if we're going to have a continuing kind of rally here over the next several months, moving into summer, that 20-day moving average should start to become real support for the markets. Again, overbought here short term, MACD is getting pretty elevated. So again, a little bit of a correction here would not be surprising, and that would give the markets the ability to kind of continue to climb here for the next month or two before we get into the latter summer months, where, again, I think we could have a correction sooner, but I think the risk of a bigger correction, kind of like we saw in April, won't be until September, October, prior to the election. So again, we just kind of get some de-risking before the election this year. Certainly would not be surprising. So that's really kind of just, for now, not a lot to worry about. Again, volatility set up for after the bell today. I have no idea what's going to happen with NVIDIA. So we've got some guesses, but again, like I said, we de-risked a bit yesterday just in anticipation of that report. Tomorrow we'll talk some more about it. Of course, Michael Liebowitz will join me tomorrow as well. We'll go over the FOMC minutes, what that said, what that means for inflation. So we'll have a lot to talk about tomorrow in relation to this. Just today, if you haven't, taken any profits in positions, there is a risk of disappointment tomorrow that could lead to a fairly sharp reversion. So again, maybe take a little bit of profit today. Just be prepared. You can always buy back later, right? Just because you take a little bit of profits doesn't mean you can't buy it back tomorrow. So again, just kind of be careful here. I have no idea how today is going to work out. That's what you need to know before the bell this morning. When we come back, we're going to pick up with Danny Ratliff talking about the risk of recession. Maybe not be zero. I've got an article coming out on Friday going much more into detail on the risk of recession. But we'll talk a little bit about it with Danny Ratliff this morning, as Jeff Gundlach made some comments about this yesterday. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Liebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I told you that my wife's been traveling for the last week and a half. She left on my birthday. She came back yesterday on our anniversary. And so I made sure that when she was coming home, I cleaned the house. I did the dishes. I did the laundry. I restocked. I went to the grocery store. I bought her favorite groceries, put them in the fridge. She got home yesterday. I took her out to dinner, because she was very tired from the long trip. So I took her to go get some food that she liked. And I thought I did a really great job. I bought her flowers, had a card for her, the whole 9 yards, right? So I thought I'd done a really good job kind of prepping everything for her return. And then I get her home, and my wife suffers from extreme ADHD, I think. I'm not sure, but so I get home. We get home, right? She goes and gets comfortable, and I'm like, okay, good. I've done my job. Everything's great. And then she flips on the Roomba. She gets out cleaning solutions. She starts cleaning stuff. And I'm like, can't win. So
that would be just like my house.
I thought I did a good job, Danny. I thought I'd done everything I was supposed to do.
That just shows you how dirty you actually were.
I guess so.
Man,
I guess so. And look, me, I use the house very little. I'm generally mostly in my office.
Yeah.
So the house doesn't really get touched much, but apparently I did not clean enough. So.
Oh, that sounds just like my house. Don't feel bad.
Okay. Well, I thought I was doing a good job. I tried. I did really try. So
we would leave for a trip and Michelle would clean the house.
Yeah.
And then when she returned, would clean the house again with nobody being there. So I get I'm like, what are we doing?
what have I missed?
Yeah.
In case the robbers messed it up.
I guess
You never know.
You never know. Anyway, we try. Husbands, we try.
You get points for effort.
Hey,
Really?
I'm impressed.
Really?
You went above and beyond,
really-
but does she notice and recognize it?
Yes, she did.
Okay, well, good.
Yeah.
But Brent says, we get points, and I've talked about this before on the show. Father's Day is the, like the 13th most celebrated holiday of the year after Arbor Day. I mean,
Well, I didn't say the points are tangible in any way.
Exactly. No, it's all good. It's all good. So we talked a little bit, as we closed the show out yesterday, we talked a little bit about, the misnomer. There's a lot of conversation out there today, particularly because of the wage gap between executives and employees, and how and we went through a good bit of conversation yesterday about how that's you're really focusing on about 1,000 companies out of 6 million where that's happening, right? And that's because of stock option compensation, et cetera. Most small business owners, Danny will tell you this is a small business owner, as we said yesterday, employees get paid first, and if there's any money left over, the owner gets paid. And there's if the company's not making money, the owner ain't taking home 5 times the salary of the employee. Generally, there's a lot of times employees get paid more than the owners in a lot of cases. But I thought it was interesting because right on the back of that article, I had a bunch of people emailing me articles yesterday, and I like this one. This was from CNBC, talking about how millennials are now quiet vacationing. And it's interesting that I got this article because I just saw a gadget that was being advertised specifically for this, and it's talking about how millennials are now in the workplace acting like they're working, but they're really not. And so again, this is the problem with remote work in particular.
Yeah.
And this gadget that I saw facilitates this. So you put this gadget on your desktop, and you put your mouse on it, and it wiggles and it moves your mouse around the screen. So it moves your mouse. And so if your employer is monitoring your computer to see if you're working or not, the mouse is moving. Now, this is like AI. When AI first came out, everybody was using it in school to write their stuff. And now schools have now developed technology to identify whether or not it's been written by AI. So we'll now have another gadget that comes out for employers that monitors whether the mouse movement is too random or not, right? So
Yeah.
yeah.
Well, but think about that. Who thought of this?
Yeah.
Somebody who probably got caught by their boss.
Exactly.
It said, to heck with this.
Well, and this is kind of to the point, which is that, we were talking about yesterday, is that, people are complaining that they're not getting paid enough at work. So now they're trying to figure out a way to not work, but still get paid. Well, employers will figure that out, and employers will figure out a way to replace you with technology that will work. And here's the other question. If you've got a job where you can quiet quit and not really work, and it's not really affecting the business, in other words, nobody's picking up on the fact that you're really not working,
Yeah.
your job is probably not that important. Or it's not important enough to the business that it can't be replaced by technology. So, you go ask an engineer, you can't, if you're an engineer for an engineering firm, you probably can't quiet quit too much, because if you're not producing the materials, stuff's not getting built, right?
Well, you would think that at some point either production's not being met,
Right.
Goals, deadlines. So at some point, they're going to catch on to this.
Right.
And I think that's more infuriating as a small business owner. Like, so wait, now you're lazy and you're a liar, right? Because now you've got somebody under giving the illusion that you're actually doing something that you're not.
Right. And so in theory, you're technically stealing from the company. So
Yeah.
But again, I get it, right? I get it. I do understand the sentiment. And here, what I mean by that is like, well, the company, because you hear this too much in the media, is like, how these executives are making so much money and the employers and the workers aren't. And so, the owners of the company is making all this money and I'm not. So I'm just going to kind of get what I can get. I get it. But again, that's the problem with the conversation we had yesterday, is that those headlines are focused around these 1,000 companies like Apple and Google, where the CEOs are making massive, millions upon millions of dollars a year in stock option based compensation, et cetera. But probably the company you work for is a very small company that really depends on you for your job. And when you're not producing at, your best performance, then that impacts the company as a whole. It impacts everybody within the company, right? So
I bet if you polled all those people,
yeah,
they all want to be rich. They're all mad that somebody else is, but yet they're finding a way not to work.
Yeah. Well, yeah, I mean, that's the whole point. And we've seen a lot of these articles, right? We've seen quiet quitting. We've seen quiet vacationing now. This is the new thing. So, we're coming up with all new ways not to actually work but still get paid. I get it, right? I understand, right? I do understand
I don't. I don't understand that. I don't.
Well, no, I understand why they're feeling this way, because of what they see in the media. Right.
Well, okay, but yeah, anybody should know better than that. That is not all business owners. That's not everybody. I mean, look, the sentiment is there, and that is correct. That's what we see in the media. But most are, they're hard workers. They put a lot of risk in. They've done a lot of things that other people weren't comfortable doing, and they're employing you to do a job. So get out there and work. And if you don't like it, go create your own.
Right. Well, yeah, And again, this is interesting because, again, most employers now provide, back when I was growing up, back when we were still just moving rocks, around stone tablets and stuff like that, you got a couple weeks of vacation, and that was it. And, now it's a couple weeks of vacation. Now it's maternity leave. Oh, now we have paternity leave for, get 3 months off as a father to stay home with you. And I'm not arguing with it, but I'm just saying is that you now have personal time off days outside of your vacation. So you have PTO days that you can take. And, there's all these other benefits that have been provided to employees. And it still seems like it's not enough. We've still got to figure out another way to try to not work and get paid.
Mental health days.
Yeah. So,
yeah.
Anyway, but see, you're old, Danny, like me. So this is a boomer problem.
No, but I'm not really. I mean, I'm technically a millennial. I'm 81.
Well, I wish you would start working.
So yeah, I need to start working.
Show up on time. That would help.
Yeah,
Rolling here about 6:15 in the morning. I mean, come on.
Those are late days.
And look at this. Danny's all trying to be Mr. Professor this morning. He's got his glasses on. He's very serious about his topic. We're going to talk about recession.
Professor
Ratliff.
Oh man.
So a couple of things real quick. We are going to talk about recession here in a second, because I do have an article coming out on Friday talking about the risk of recession isn't zero. And, this is, kind of become more of a much more mainstream narrative as of late, because, it's now kind of common belief that we've avoided a recession. The Fed has done the impossible and has navigated the soft landing scenario. And it all sounds great. And there's certainly a probability of that. I can't say that there's not a probability that because of all this monetary intervention, et cetera, that we won't avoid a recession. But the risk of that recession is still not zero. And I think as an investor, you have to certainly kind of, understand what that risk is and at least be aware of it as we move forward. Now, there's a big difference that, I see a lot of videos and things talking about, this is going to crash and this is going to crash and that's going to crash and the world's going to end. We should not be hoping for that kind of stuff, right? I mean, that's not good for anybody. I mean, if you're short the market, it'll be great for you. But, it's not great for the economy and economic prosperity and future wealth building, et cetera. So we really shouldn't be hoping for these more dire outcomes. And you see a lot of these on kind of YouTube channels and things where people are trying to sell fear and trying to sell you a product, whatever it is. So we certainly shouldn't be hoping for this kind of end of the world scenario, but recessions are a normal part of the economic cycle. And that doesn't mean, and again, people have now equated a recession to the financial crisis. So when you talk about a recession, it's like, oh my gosh, we're going to have another financial crisis. Markets are going to be down 50%. It's going to be terrible. The world's going to fall apart. That's not what a recession is. But, we have to understand that a recession is part of the normal economic cycle. It does have a consequence for markets because it does reduce earnings. But again, we have to segregate out financial crises from normalized recessions. And we'll talk about that when we come back from the break with Danny Ratliff. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
back to the show this morning. So a little bit about recession, and there was a survey out this morning. 64% of investors think there will be no recession. About another 28% think that, there is a risk of recession, but not a big one. Soft landing is more the, economic slowdown type thing, and soft landing. A very small percentage, like 2%, think there's actually a recession risk. So again, for the vast majority of investors that are surveyed in the marketplace, no recession is the outcome. Almost 100% of economists think there's no recession risk right now. I mean, pretty much you ask any economist, like, yeah, absolutely no risk of recession. Everything is fine. But the risk of recession probably isn't zero. And this is part and parcel of the commentary we're writing for Friday. If you take a look at inverted yield curves, which have a long track record of basically predicting, I shouldn't say predicting, but preceding recessionary downturns, there's about a 15-month lag. So we're still within the window of that inverted yield curve and a recession for later this year, potentially early next year. If you take a look at history, one of the big issues is that we had elevated GDP so much. We were running at about a 15% nominal GDP growth in 2021. So you've got to reverse all of that to get back to zero and go negative in order to have a recession, right? So a recession is negative economic growth, right? So you've got to reverse all of that economic boost we had. So think about, we pushed the economy to the top of a mountain. Now we got to come all the way down to the mountain and then go into the valley before we get a recession. We had some traveling to do. Well, we've had that previously in history. Back in the 70s, we had a similar kind of nominal growth rate in the economy, and it took about 22 months to get to a recession. So again, that would put us into the first half of next year. So, there's certainly some concern about risk. And Jeff Gundlach, actually, on Market Watch today, Market Watch had interviewed Jeff Gundlach, asked him about the same question. And Danny, he's also suggesting that a recession is not necessarily off the table right now.
Yeah, I think this is key. He's been saying this for a while, though, and this is what you have to do with most of this commentary is take it with a grain of salt. We are beginning to see and hear more and more, I think, recession calls. Mm-hmm. And, some of those things we've talked about, you have that flashing yellow light of, hey, we've got a yield curve that's been inverted for quite some time, well over 2 years now. Yep. We've got a leading economic index, which was negative all the way through to, December? Mm-hmm. I mean, this is one of the longest times in history we've seen. Those are two fairly good indicators. But yet, kind of like price to earnings, it may not happen right away.
Right.
It's a great longer-term indicator. But we can always suggest and think that there should be a recession at some point. The issue that we've seen now is that they have tried to eliminate a recession from the business cycle. And so what I'm hearing and seeing, though, from a lot of different people, Lance, is that, hey, I want to be super conservative now. Mm. Or, we had that FOMO, the fear of missing out. And, there's another study I want to get to in a bit that talks about the amount of people that are actually investing in stocks now is at 2008 levels. Right. So I think we saw that leading up to that time. And so we don't have that irrational exuberance, at least it does not feel like that at the moment. But what I'm seeing more caution, where people are a little bit more prone to say, you know what, let's go ahead and take a little bit of these profits. Let's go ahead and reduce exposure, kind of like what you talked about in the first segment. Or I'm hearing people that are like, hey, I'm all out. I've sold everything. I'm kind of waiting. Now, how do I get back in is the big question.
Right.
And that's a conundrum that many people are faced with. Hey, I believe this is going to happen, but, I also understand I probably need to add some exposure. Now, the problem with believing something's going to happen is that may not be factual, right? That's just how we feel.
Right. Well, and the other problem, too, is the kind of misconstruing the recession in a degree. Again, we haven't had a recession other than the pandemic shutdown, right? So we shut down the economy and we had the market decline by 35%. And then it was over in a month, and then we were back off to the races, right? So we had a recession there, but that was a man-made recession because we actually shut down we basically caused the recession by saying you can't go to work, right? I mean, you can't do anything, so yeah, you're going to have a recession. So, but even with that, yes, the market's declined by 35%. It was in a month, it was over, and then the market started rallying again. So the only real recession that most people have a reference to of any sort that they can remember is the financial crisis. And so now we've kind of equated a recession being a financial crisis. And so, if we have a recession, market's going to be down 50%. I'm going to lose all my money. That's not a normal garden variety. That's a very deep negative recession. You were shutting down banks. You had a freezing of credit. You had a massive, kind of deluge of problems that all culminated from this lack of trading between banks. And we're not going to have that this time. So you have to go back and start looking at more normalized recessions. What happens during a normalized recession, and what does that look like in terms of market returns and issues with credit, those type of things. And again, it doesn't mean that you're not going to have a market downturn, yes, but it's not going to be 50%. You might have a correction like we saw in 20, and if there was kind of a market environment, we may still see this at some point where the National Bureau of Economic Research comes out and says, oh yeah, there was a recession in 2022. Markets were down 20% and, it was real choppy decline and we had negative earnings growth and a slower economic environment. So they may still come back out and backdate a recession at some point. I'm not saying they will, but I'm just saying that you could come back and date the 2022 period as a recessionary period. That probably won't happen, but that may be kind of what we're looking at. So the next recession, if we do have one next year, as an example, you might be talking about a market that, declines by 20%, maybe at the most, 25%, something like that. And it's not going to be across every asset class. It may be that large caps decline by 20%, but small caps finally get a bid. Or it might be a rotation finally from U.S. domestic stocks to international stocks. I don't know what it's going to be. We'll have to figure that out when we get there. But very much like the dot-com crash that we saw back in 2000, that was a recession. We saw dot-com stocks decline that had no business model for the most part, no revenues. But small caps did great. Small caps, mid caps did well. Bonds did well. So other asset classes will do fine. So it's important, Danny, to what your point is that, don't just when you hear the word recession, the media, loves to use that word recession like, oh my gosh, it's going to be a financial crisis, scare the bejeebers out of you because that gets headlines and clicks and views. And it's great for media, right? But it's not necessarily, a recession isn't a bad thing. A recession is actually a normal, healthy part of the economic cycle. And we need that recession in order to clear out some of the excesses so we can get back to work and start getting the economy growing again.
Well, I think that's a great point, is that understanding that where's this information coming from and for what purposes? Is it to get somebody to watch their podcast? Is it to get somebody to remain on watching whatever business channel you're watching? Likely, right? Those guys are there to sell ads effectively. So, we have to remember that. Now, not to say that there's not those issues, on the horizon, but recessions don't happen nearly as often as bad markets. However, if you guys have been listening or watching us for some time, that, our goal is to mitigate risk to the downside. We're more active than most and still participate to the upside when managing money. So we take that and we understand, protection of funds is extremely important, especially once we're in distribution phase. So keep that in mind. But at the end of the day, we've got to go back. The problem, I think, Lance, is that most people can't think of a time that there's a recession outside of the great financial crisis.
Right.
COVID, great financial crisis, and then dot-com bust, right? What else has been there that would cause anybody to say, oh, that was terrible? Most people can't even remember a time.
Right, I know. And look, we've forgotten, what it was like during the dot-com crash for the most part. Yep. People can't really remember what markets were like then.
When it was 3 years, it wasn't like you had some 50% drop. It was just 3 years of poor returns.
Well, it was 50%. Peak to trough, correct, it was 50, correct. But it took 3 years to get there.
Yeah.
Right? It was just terrible.
It just wasn't some big,
right.
Like rip the Band-Aid off, boom.
You had so many opportunities to reduce risk during the dot-com crash. Markets would rally and you could reduce risk and then it would decline some more. But yeah, to your point, it took a very long time. But again, most people don't remember that very much at all. Their only real relevance to any type of recession, and for many investors today, you have to remember a lot. We see all these people on Robinhood trading and these type of things. Buying options and trading this and trading that. They've actually never seen a recession because they were born prior to 2008, but they didn't get old enough to start trading until after 2008. Their first presidential election that they voted in was the 2008 presidential election with Barack Obama. So that's their whole thesis about the market has occurred post 2008. There's a lot of writers that are writing articles that weren't in the markets.
That never experienced it.
They've never been through a financial crisis like 2008. They started writing in 2011, 12, 13, 14, 15, 16. So they're, a lot of these media personalities have never been through a crisis, and they're writing articles, telling you, oh, stay invested, do this, the other thing. But they've actually never been through a recession or a bear market. So they really don't understand what they're writing about. And so it's really important to have a little bit of history on your side, go through these things, understand them. I've lived through them. Danny's lived through them. Michael Leibowitz have lived through them. And that's important because we have some perspective about how these things actually work on the inside, because we were managing money inside of these events when they occurred. So we have a baseline to work off of that. And this is why you may not agree with a lot of things I say to you, and that's okay, because I see the comments that y'all write in the chat. But I've been here and seen this numerous times before, and I'm just telling you this is how things are going to work out, because that's human nature, right? It's just the way people react. All right. Quick break. We'll come back. We'll talk about America's favorite long-term investment when we come back from the break. It's probably what you think, and we'll talk about that. Don't go away. No, it's not NVIDIA. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Danny was 6 in 1987.
That is true. I never said I was there.
I was.
Not physically managing funds.
I was physically in the middle of it. Now, I was only about 6 days into my first job when 87 crash happened, and my boss had me completely convinced it was my fault.
It was.
So that was a great way to start your career, right? So I didn't realize you were that young. God, you're just a baby.
42.
Yeah.
Oh, but still, I was just dumb enough to get in this as my first career, right?
Yeah, exactly.
20 years. And,
Matador says I'm having a Lance Old Man rant. Yes. And that's why y'all tune into this show, just to hear me rant sometimes. So, exactly. Get off my lawn. Okay, America's favorite investment. I thought this is interesting because, no, it's not Bitcoin. Stop it. And this is, we talk about building wealth and investing, and y'all watch this show because you're invested in the financial markets. And it was interesting. So the survey came out, and they interviewed people, and they said, okay, what's your favorite long-term investment? Only 22% of the people said that stocks and mutual funds were the best vehicle for investing long-term. And, it's a very interesting point because we've talked about this before, is that what the markets are for is only one thing, is to ensure that your savings are growing at the rate of inflation over time. So if that's my savings, right? So what am I actually investing in? So yes, I'm investing in the markets. Yes, that is a true statement. But the goal of that investing is just to make sure my savings grow over time so that my $100,000 that I have today has the same spending power 30 years from now when I need those savings to live on. That's the goal of investing. And the problem is when you start speculating in financial markets, that's when bad things tend to happen to people. But what was interesting is that really, and if you take a look at high net worth investors, then this is, where do rich people, I'm talking about really rich people. I'm talking about people with, 50, 100 million, $200 million in funds. Where are they investing their money? Well, if you take a look at high net worth surveys, you will find out that out of all of their money, only about 20% of it's invested into the financial markets, hedge funds, stocks, those type of things. The rest of it is in their business. So they typically invest heavily in their own business. I was having lunch so if you live in Houston, you'll be familiar with Mac McInville, who owns Gallery Furniture. He's been in Houston for 40 years, has built basically a furniture empire here in Houston. Very successful, very wealthy.
Mattress Mac saves you money.
Exactly. So if you live outside of Houston, you may know who he is, but if you live in Houston, you definitely know who this guy is. Very philanthropic. I was having lunch with him several years ago, and we were just talking about markets and kind of the political cycle and various things that were going on. And I asked him, I said, well, I'm just curious, how much money do you have invested in the financial markets? And he's like, none. He says, it makes no sense to me to invest in the financial markets when I make much more money on every dollar I invest in my business. So when I buy a piece of furniture and I sell that piece of furniture, I make more money on that than I do in the financial markets. So if you take a look at high net worth investors, that's what you'll see, is that a big chunk of their net worth is in their business, whatever it is. And then a large chunk of their net worth is in America's favorite investment long-term, which is real estate, right?
Yeah, and I think that, here's the caveat with this that I always find interesting. Well, real estate, for most people like that, they're not looking at their home as an asset per se. The problem with this is that the majority of people look at their primary residence, but yet they're never going to actually liquidate that to capitalize on it. They don't sell. They want to. Lance, you've done a good job of this. My
wife hates me.
I don't have the intestinal fortitude to go through that with my wife or with 3 kids. And I'm not sure how you did all these years. But, Lance has gone and sold almost at the peak of markets, rented, and then bought again. That is using that as an investment vehicle at that point. But most people don't do that. Yeah. I would say 99% of people don't do that. And they look at their home or their primary residence as their biggest investment. And that's the problem, because how are most people going to actually extract that liquidity out of it? Richard always says, he has a good analogy with this. He says it's like when you're paying off a home with cash you have on hand, you're turning water into ice.
Right.
And so now we've got to, how do we extract that ice to get funds later, right? Are you using a reverse mortgage? Are you going to sell and downsize? We're finding many people who like to downsize right now, they can't do it.
Right.
Because even if they go and they sell a home that's larger that maybe they use for their family, it's older now. It's not worth as much as what they're having to go out and buy for something even smaller. Mm-hmm. So I think this is where it's problematic with many people and their primary home being their biggest investment.
Right. And this is one of the areas that, again, I don't have any beef with Dave Ramsey, right? I just disagree with some of his financial counseling. One of the things he does counsel on is paying off your house, right? Being debt free, paying off your mortgage. And to Danny's point, that's okay. If you're really in debt and you don't have an ability to create cash flow and you're just trying to make ends meet all the time, sure, pay off all your debt. I'm actually a big fan of that, right? No credit card debt, no auto debt.
I'm a huge fan of that.
Get rid of all that debt. But don't worry about paying off your house, because the house is what you're living in, right? So just pay the mortgage payment, deduct your mortgage interest on your taxes if you can, and live there, right? But if you sink all your money into your house, great, you're debt-free on your house, but now you have nothing growing for you. And again, to Danny's point, the only way you can extract that capital from your house is to sell it. But that house has ongoing expenses, right? It's constantly HOA fees and maintenance and upkeep and taxes and all the other things that go into owning houses. So it's constantly eating away at income and a house that you paid for, right? And so use the capital to invest in other assets to grow. And then at some point, as you grow that wealth, if you want to come back and pay off your mortgage down the road, great. If you've secured your retirement and you're ready to, and you're good to go, then yeah, go pay your mortgage. Who cares? But I wouldn't make that a priority. I would pay my mortgage payment, put it out on 30 years, get the lowest payment possible. Especially if you've locked something in at 3 or 4%, don't pay that off, because you can't refinance at 3 or 4%.
Yeah, I had that conversation with somebody yesterday. So let's look at all of your debt, and business debt, everything that they had. It's like, man, you're locked into such good rates, you can't do it.
Exactly. Yeah, you just
could let money sit in a money market. This guy could, and it was better off to let it sit in a money market. Mm-hmm. Use arbitrage to your favor. But that's the key, is that while your home is an asset, it's typically not that investment where you're going to be able to turn around, because that is usually only keeping up with inflation, because you're going to have to turn around and buy something else.
Right.
And whatever that cost is going to be.
More. And so, so going back to high net worth investors, they do have a lot of their money tied up into real estate. It's either, residential houses, multifamily housing, commercial real estate, farmland, those type of things, because there's songs out, that they've written, and statements, they're not making any more land, right? So land has an inherent value, and regardless of what happens, whether you have a recession or whether you have an economic downturn or a financial crisis, whatever it is, that property is going to maintain value. Property will never go to zero, right? I need to be careful saying that, because we've seen a lot of commercial real estate go to zero lately. but generally, land has value. And so if you take a look at high net worth investors, they have 20% of their money in hedge funds, mutual funds, stocks, market-related investments. They have generally about another 30% of their money tied up in their kind of their business, whatever it is. They'll have another 20, 25% in real estate, and they'll have a big chunk in fixed income, because like real estate, fixed income has a return of principal function to it. So treasuries will never go to zero, and they'll give you a rate of return over time. And so, for people that have built wealth, one of the important things is to preserve that wealth, not lose it. So, they focus on investments that have the least risk over time of generating big losses. And that's why they have a very small portion of their overall assets in stocks.
Well, and that's actually, we found that more and more people are doing it. So this all comes from a Gallup poll. This is their annual economy and personal finance survey. So it said 36 respondents in the survey conducted in April chose real estate about the same as last year. 22% named stocks or mutual funds as the best investment, 18% gold, 13% savings account or CDs. Only 4% chose bonds, which I could see why, if going through 2022, if you had bonds in the portfolio, and then 3% in cryptocurrency. So it's also interesting that the report noted real estate has sat astride the list each year since 2014, right? So why did nobody like it after that, right? Because you had the 2008 crisis, it went way down. So people said, hell, what the heck with real estate? But what I did kind of took note of, mentioned this earlier, is that right now they're saying 62% of U.S. adults have money invested in the stock market, including individual stocks, a stock mutual fund, a retirement savings account. The figure is essentially unchanged from last year, but reflects a return to stock ownership levels not seen since the 2008 recession.
Right.
So, we talked a little bit about, do we get that irrational exuberance, that fear of missing out And, similar to what we saw in 08, we had, 2001, 2, and 3, which were negative. And then we saw the markets began to reward. And, people were being rewarded to invest in the markets. And are we seeing that once again?
Yeah, no, look, I mean, it's the number of people that are invested in the financial markets now, like you said, back to the highest levels on record that we've seen, even going back to the dot-com crisis. And that's just the exuberance, right? To your point, right? People are just very excited about the markets because that's what you hear about. The market's at all-time highs, and that's just dragging more and more money into the markets. But again, markets are overvalued. Markets will revert. And at some point, a recession will allow that to occur. And that's a healthy thing, by the way. So again, just keep that in mind. Okay, got to wrap up the show for the day. Danny, thank you so much. We appreciate it. Be back tomorrow with Michael Leibowitz. We'll cover the FOMC minutes. We'll cover NVIDIA's earnings this evening, what that all means for the markets today. Again, that is really kind of the big news. Not a lot out today. And then tomorrow we've got Chicago Fed National Activity Index out tomorrow. We'll touch on that as well. All right, have a great day. We'll see you back here tomorrow.